everybody, welcome back to another episode. Today, I want to go over the sections in our book, 100 Questions Business Owners Ask Before Investing. I'm not going to go over all 100 questions. If you want to grab this free ebook, you can go to our website, hbgcapital.net. That's hbgcapital.net. I wrote this book because I got a call from one of our investors one day asking if I would take a phone call from one of his friends. He said his friends was in a very dire predicament. They had invested money with somebody in a real estate deal in California and lost a lot of money. It became very evident to me when I was on the phone with this gentleman and he was telling me his story, how he invested money with a real estate sponsor that he trusted, that had a good name, and it went sour. They stopped communicating with him, stopped answering his calls. And, finally, I think they got in touch and he said, look, money's gone. I can't help you out here. And he was basically wondering what his next steps were, what he should do. And unfortunately, there was not much he could do because he did not do the proper legal work. He did not secure the investment. And I realized that this was a bad experience for him because he was green. He knew that real estate was a great vehicle that could create generational wealth. He knew that it could be completely passive, but he did not know the right questions to ask to vet this opportunity. And so I wrote this book, 100 Questions Business Owners Ask Before Investing, with the intention that if I could prevent this from happening to just one other person, it would be worth it, because you need answers, but you don't know the right questions to ask to get the answers that you need a lot of the times. Answers are what prevent catastrophes from happening. But you need questions, the right questions specifically, to be able to unlock those answers. So that's what I want to give you today. I want to break down the sections in this book and why they're important. Again, I'm not going to go through all of the questions here. Feel free to go on our website and grab it, but let's jump in here. So the first section of the book deals with the operator. Now, the operator could be the person that you are investing your money with. It could also be the person who is managing the asset. So usually there's a sponsor and an operator. Sponsor is usually the one sponsoring the deal, doing the due diligence, getting everything set up, raising capital for the deal, doing the underwriting. The operator could be the general partner in the deal that's in charge of like managing the asset or building the asset, something along the lines of the operating partner. And it's very important that you do your homework on this person, because most people only do their homework on the sponsor, the people that they see doing the money. It's very important that you also know who the operator is, because the sponsor can have a great reputation, but if this operator who is building the building or developing the land or managing the multifamily apartment complex doesn't have a good reputation, that's a problem. The operator is ultimately the one who's executing the pro forma and the business plan, and you need to vet the operator just as much as you would do the sponsor. And a couple things to keep in mind: experience is key, background check. You want to see performance. You want to see that they have done this time and time again and that they have a very good reputation. So make sure you're looking at the operator who is actually doing the deal and managing the deal itself, not just the person that you're giving your money to and that's raising the capital. The second section of this book deals with on-site property management. And so this is kind of the same thing. It's more specific to like multifamily. I kind of just named this. Again, sometimes the sponsor is the one who's also the operator. Sometimes you've got a sponsor and they're just hiring out a third party. So if there's going to be like on-site property management after this asset has been executed, make sure you understand who that is as well. So just to kind of break that down, if you're building a neighborhood or you're building an apartment complex, who is the operator that is building it? And then if it's going to be leased out afterwards, who is the property management company that is going to be managing it? Because if you have a bad property management company, then you can do all this work and it'd be for nothing because it's not being managed right. So do your homework on the on-site property management after you've executed the pro forma, et cetera. If this is relevant, if it's an apartment, property management's probably going to be involved a little bit earlier on. If you're building it first, you need to do your due diligence on the developer and builder, and then on the property manager afterwards. So very different distinctions right there. There's a before and after. The next section deals with the loan. If you're investing in a deal and it's not a 100% equity deal, in other words, there's going to be some debt involved, usually a bank, it's very to understand what kind of debt this sponsor, this operator is taking on. The most important thing is to understand where your capital stacks up in the deal. So they call it a capital stack. If you were to think of it like this, it's the cash that's stacked on top of each other. So imagine different levels where at the very bottom of the level, you've got the bank debt. And then above the bank debt is the level of the investor equity, the investor capital. And then above that is another level that is hopefully profit on the deal or equity or potential profit. You need to know how far down can the asset's value drop before your investment breaks even. In other words, you get your principal back. Because anything lower than that means that you're going to lose money. Because that bank debt, it's getting paid back no matter what. Doesn't necessarily mean that your equity is going to get paid back. So very important to understand where your capital is in the stack of the deal and what type of loan you're getting. For example, one of the reasons why commercial and multifamily real estate's gotten a bad rap, especially over the past year, is because there's a lot of these, foreclosures that are kind of coming. Interest rates have shot up. Everybody knows that the value of commercial and multifamily property resides on interest rates, because the interest rate, the mortgage payments, one of the largest expenses in the when you're managing that kind of asset. And so it directly influences the price of these assets. So because of that, a lot of people will take out, for example, bridge debt was used on a lot of multifamily properties to get short-term loans to be able to purchase the asset, renovate it, and then refinance into a long-term loan. But the problem with that bridge loan is while you were in the bridge loan, and again, a bridge loan is a very short-term loan, interest rates shot up, and all of a sudden, all of these bridge loans that were coming due, they could not refinance them. So they're having to ask investors to cough up more money to cover the difference between what they paid for the property and the new loan then that they can get with a new bank. So literally, if you bought a property for $100 million and you were like, dude, it's going to be worth $120 million after I do a few million in renovations, interest rates go up, all of a sudden your property's worth $80 million and you can only get a loan for like $70 million. That means you got to go cough up quite a bit of cash to be able to pull your investors out of that deal, or at least keep their equity safe. So big things are happening in the commercial realm. It's very important to understand what type of debt you're getting into. Is it fixed rate debt? Is there an interest rate cap that prevents the interest rate from going up to a certain level? When is the debt due? Very, very important you do your research on the type of loan and debt that's being taken out. The next section goes over property-specific due diligence. Doesn't matter. You could have the best operator in the world. If you've got a crappy deal, then your investment's going to be crappy. So those are the two big parts that I tell people to look at. One is the operator, the sponsor operator, and then the deal itself. Those are the two parts of the deal that you analyze. Everything else falls underneath those umbrellas. It's got to be a good deal. So make sure you're doing specific due diligence on the area and on the deal itself. The next section is the market. Make sure that you're not investing in like Detroit, Michigan during 2010, 2011, 2012 when everybody was leaving that town. I remember driving through Detroit, Michigan, and like there were these just skeleton buildings where all the windows were out. You could like see through it. It was just like empty buildings everywhere. Detroit at the time, I remember the population was declining. So it doesn't matter if you've got like a great area, a great deal. If people are leaving that area, money is flowing out of it, that is a red flag. Make sure that the market that you're in and the specific area you're in is very good. The next section goes over property performance and projections. So kind of goes back into doing property specific due diligence. You want to make sure that there is a value add play here. You want to make sure that your equity is being protected, that your investment is protected. Usually this means a forced appreciation plan. So with land, for example, we force appreciate it by taking it from a few homes to 100 homes plus, right? There's a lot of value that's created there before we buy it. We force appreciate the value of that land. In multifamily, you renovate the units, you increase rents, boom, you have force appreciated the value of that asset, thus insulating the investment. So make sure that you've got some kind of, you're doing research on the property performance and the projections. The last section here, this is everybody's favorite, the legal documents. Make sure you read the legal documents. If you don't understand what anything means, and it usually takes me 2 hours to read through the legal documents every time and highlight everything and go back and forth with the attorneys, make sure that you get your questions answered. The sponsor and operator should allow you access to the attorney who drew up the legal docs. If they don't, that's a red flag. You should be able to get all of your questions answered directly by the attorney that created the legal documents. So it is a bunch of legal jargon sometimes. They have to explain it to you. You can also hire your own attorney for, $200 an hour. So it might cost you $400 or $500, but well spent if you're going to invest hundreds of thousands of dollars to review those legal documents and let them know what you're getting into. You need to understand in what situation can they ask you for more money, a capital call. In what situations can you remove the operator if they commit fraud, etc.? What are your rights as a limited partner in the deal? Very important that you understand everything that's involved in the legal documents and how it can affect you. That's it for today's episode. If you get value from these, do me a favor, leave us 5 stars, share this with your friends and family. We'll see you next time.